Tonight, we're not talking about politics. We're not talking about parties. Serious. We're talking about your money, your paycheck, your gas tank, your grocery cart, your mortgage, your retirement account, and the uncomfortable truth that every single one of those things is being reshaped right now by a war happening thousands of miles away. Since the United States and Israel launched Operation Epic Fury against Iran in late February, the economic shockwaves have been relentless, and they are accelerating. What started as a spike at the gas pump is now spreading into your food prices, your housing costs, your savings, and the stability of global financial markets. So tonight, I'm going to walk you through, clearly, honestly, and without sugarcoating, exactly how this war is hitting your wallet, where it's heading next, and what you can realistically do about it. Pause now. Let's start where you feel it first. At the pump. The gas price shock. America, the numbers don't lie. On a recent Saturday, nationwide unleaded gas prices hit nearly $4 a gallon on average, according to AAA. That was up from just under $3 a gallon just 2 days before the US and Israel attacked Iran. A surge of roughly a third in just 3 weeks, triggered by rising oil prices from Iran's blockade of the Strait of Hormuz. In California, gasoline prices surged above $5 per gallon during the second week of March. And diesel, the fuel that powers the trucks carrying everything you buy, is now just under $5 a gallon, according to AAA. Global crude oil prices spiked to nearly $120 a barrel about a week after the war began, then fell to around $100, where they've been hovering. Before the war, oil was closer to $70 a barrel. Now, President Trump dismissed these price hikes. He said it is a very small price to pay for USA and world safety and peace. He later stated he is not concerned if gas prices go up, saying, if they rise, they rise. But here's the reality for the average American family. Since the U.S. launched military operations against Iran, American families are paying nearly 80 cents more per gallon for gas every time they fill up. More than $300 million in additional costs every single day. That's not a small price. That's a tax on every working family in this country. And this is not a normal price spike. The head of the International Energy Agency described the situation caused by the war as the greatest global energy security challenge in history. Let that sink in. Not since the oil embargo of the 1970s. Not since the Gulf Wars. This is being called the worst energy shock ever. Why the Strait of Hormuz changes everything. To understand why this is so devastating, you need to understand one piece of geography. The Strait of Hormuz. Iran can use the narrow waterway as a strategic lever, as the passage for about 1/5 of global oil and liquefied natural gas consumption. Disruptions or even threatened closures can elevate gasoline prices, fan inflation, and lead to declines in household consumption in the U.S. When the Trump administration's war on Iran began, all shipping through the Strait of Hormuz was effectively halted, removing roughly 1/5 of the world's oil and gas supply from the market. And it's not just oil. Prices for liquefied natural gas are also a worry. LNG prices in Japan and South Korea are up nearly half. Jet fuel costs are spiraling, along with those of more esoteric commodities such as helium. Chevron CEO Mike Wirth said, there are very real physical manifestations of the closure of the Strait of Hormuz that are working their way around the world. And here's the terrifying part that most people aren't talking about yet. The world will hit an oil cliff in mid-April because supplies from the Strategic Petroleum Reserve, as well as Russian and Iranian oil exempted from sanctions, will run out. The CEO of Kuwait Petroleum Corp said it could take 3 to 4 months to return to full production once the war ends. So even if a peace deal is signed tomorrow, and it won't be, we are looking at months of elevated energy prices. Inflation, the second wave. Now, gas prices are the first punch, but inflation is the knockout blow, and it's coming. The longer this lasts, the more significant the shock would be, said Gregory Dacko, chief economist at consulting firm EY Parthenon. With U.S. oil prices increasing roughly 42% from their pre-war levels, that could push up inflation in the United States to 3% or higher in the coming months. Economist Daco estimated that the bump in gas prices could push monthly inflation to as high as 1% in March, which would be the highest monthly increase in 4 years. Yearly inflation would near 3% in that case. But that's the optimistic scenario. The Organization for Economic Cooperation and Development this week projected U.S. inflation will reach over 4% this year. Before the war, the International Research and Policy Group had projected 3% U.S. inflation. And 4% plus inflation would come on top of 5 consecutive years of elevated inflation. Consumer prices are up a quarter since December of 2020. Read that again. A quarter of your dollar's purchasing power gone in just 5 years. And now it's about to get worse. Certified financial planner Stephen Cates at Bankrate said, rising oil prices have a direct and immediate impact on consumer costs, and not only at the gas pump. Unlike last year's higher tariffs, which took months to filter meaningfully into prices, increases in oil prices are quickly reflected. An immediate spike in gasoline prices strains household budgets and also raises the cost of shipping, airline tickets, and products that rely on oil-based inputs. Economist Mark Zandi of Moody's put it even more bluntly. Higher oil prices are another negative supply shock, lifting inflation and hurting growth, putting the Fed in a no-win situation. And this is where the Federal Reserve enters the picture. In an energy supply shock, the Fed is likely to avoid big, sudden interest rate moves, instead favoring smaller changes or pausing while it watches incoming data. The reason? Tightening monetary policy to fight inflation can also slow growth and hiring, while easing policy to support the economy can add fuel to inflation. The Fed is stuck. They can fight inflation by raising rates and tank the economy, or they can cut rates to save growth and let prices run wild. It's a lose-lose. Federal Reserve Chair Jerome Powell himself admitted it. The thing I really want to emphasize is that nobody knows. The economic effects could be bigger, they could be smaller, they could be much smaller or much bigger. When the chair of the Federal Reserve tells you nobody knows, America, pay attention. Your grocery bill is next. Now, let me talk about something that's going to hit you even harder than the gas pump, your grocery store. The ongoing war between the U.S. and Iran could soon lead to higher grocery prices in the United States and around the world, as disruptions to key shipping routes drive up the cost of fertilizer, fuel, and ultimately, food production. Here's why. The Middle East is a key exporter of urea and other nitrogen-based fertilizers used to grow staple crops. According to the Center for Strategic and International Studies, about a third of global urea exports and more than a fifth of fertilizer shipments typically pass through the Strait of Hormuz, a vital shipping corridor that has been largely shut down. Fossil fuels are a primary feedstock in the production of fertilizer, often accounting for as much as 80% of the cost of production. Altogether, fuel costs account for between 40 and 50% of all variable costs of growing crops in countries like the United States. At the grocery store, the damage will be felt twice. First, more quickly, as rising diesel prices raise the cost of the tractors, trains, and trucks that move groceries from the field to the grocery store, and then again months later, as the fertilizer price shock works its way through the agricultural supply chain. Grocery prices are already up nearly 4% over the last year, and Iran's blockade is throttling the global supply of fertilizer, which could create new pressures on food prices come harvest season. In a public letter to Trump from the American Farm Bureau Federation last week, over 50 agriculture groups laid out the challenges facing American farmers and how this new conflict with Iran is impacting them. They detailed how severe weather, high expenses, and global uncertainty are squeezing the farming industry to the breaking point. And if you think this is just an American problem, the World Food Program has warned that the world could see record levels of food insecurity this year if the Iran war continues, with an estimated 45 million more people being forced into acute food insecurity as a result of the conflict. Christopher Barrett, an agricultural economist at Cornell University, said, "It's going to start having an impact soon here in the U.S., even sooner in some other places where fuel prices are a much bigger part of the cost of food on the grocery shelf." American families planning spring break and summer vacations will face sticker shock when they search for flights. Jet fuel accounts for roughly a third of airlines' operating costs in normal times and has surged approximately 85% since the start of the war. From the gas pump to the grocery aisle to the airport counter, every line item in your family budget is under assault. Your mortgage and your home. Now let's talk about the American dream, owning a home. Because the Iran war is reaching into that too. The U.S. housing market was supposed to turn a corner this year, but economic uncertainty and a jump in mortgage rates fueled by the war are complicating affordability for American homebuyers. After years of sluggish sales, economists expected lower mortgage rates and more homes for sale, breathing new life into the market. But the average 30-year fixed mortgage rate has been climbing for weeks straight to levels not seen in more than 6 months. One day before the strikes began, the average rate on the 30-year fixed loan was just under 6%. It is now hovering around 6.5%. Higher rates have curtailed what was expected to be an improvement in affordability. What does that mean in real dollars? On a home valued at around $450,000 with a 20% down payment, a buyer who locked in a 30-year fixed mortgage rate 1 month ago would pay about $1,100 less per year than someone securing a rate today. That amounts to more than $33,000 over the life of the loan. $33,000. Because of a war that started just weeks ago, the Iran war has triggered energy inflation that's dimming the prospects of interest rate cuts and keeping borrowing costs higher. Mark Hamrick, senior economic analyst at Bankrate, told ABC News the Middle East conflict is hurting the opportunity for Americans to make ends meet, much less afford a potential home purchase. Last week, mortgage applications fell by over 10% from the week prior. Buyers are less willing to participate in bidding wars compared to previous years. Lisa Sturdivant, chief economist at Bright MLS, said, "The outlook for the spring home buying season has become cloudier than it was even just a month ago." The spring selling season, even the most important time of year for the housing market, is being suffocated by a war in the Middle East. If you're a young family trying to buy your first home, this war isn't abstract. It's the difference between getting the keys and being locked out. The stock market, your retirement at risk. Now let's look at Wall Street. Because your retirement accounts, your college savings plans, your investment portfolios, they're all feeling this. The Dow, S&P, and Nasdaq are each set for their worst month in a year. U.S. stocks closed sharply lower recently. The Dow fell nearly 500 points. The S&P had its worst day in 2 months. The Nasdaq sank over 2% and closed in correction, down more than 10% from its peak. The war in Iran and the spike in energy prices have rattled global markets, impacting not just stocks but also safe havens like bonds, gold, and currencies. That's leaving investors with fewer places to hide. Adam Turnquist, chief technical strategist at LPL Financial, said, "It all boils down to oil markets and the implications on inflation." There's really no clarity on when this war will end, despite a lot of confusing commentary. Sam Stovall, chief investment strategist at CFRA Research, said, "The market has taken a 1-2 punch and is staggering like an aging boxer." But here's an interesting twist. Not every sector is suffering. Energy stocks are up roughly a quarter. So the companies profiting from higher oil prices are doing just fine. It's everyone else who's getting hammered. Goldman Sachs Research noted, "There is going to be some lasting damage, and their economists have downgraded their growth and upgraded their inflation forecasts pretty much around the world." Morgan Stanley warns that rising defense outlays could widen deficits and push long-term treasury yields higher, raising borrowing costs and weighing on rate-sensitive markets. U.S. engagement with Iran could increase defense spending close to the president's massive defense spending request. A 50% increase to the defense budget and a level not seen since the Korean War. This sharp spending rise would add more to the U.S. government's already outsized debt and deficits. And then there's this. A Financial Times investigation found that hundreds of millions of dollars in bets on falling oil prices had been placed just minutes before Donald Trump published his statement on postponing attacks on Iran, which caused oil prices to fall for a while. This resulted in speculation about insider trading and calls for further investigation. Someone made hundreds of millions of dollars betting on presidential announcements before they happened. While you're paying $5 a gallon, all right, the Federal Reserve's impossible choice. Here's where it all converges, America. The Federal Reserve, like the institution that controls interest rates and has the single biggest influence on your borrowing costs, is paralyzed. Economist Zandi said, the uncertainty created by the turmoil in the Middle East will ensure the Fed puts any changes on monetary policy on hold until policymakers can better gauge whether the inflation or growth effects of the fallout are predominant. Traders are now pricing in no rate cuts from the Federal Reserve this year. Think about what that means. At the beginning of this year, markets expected multiple rate cuts, which would have lowered your mortgage rate, made car loans cheaper, reduced credit card interest, and boosted the housing market. All of that gone. The impact of the conflict echoes the 1970s energy crisis through acute supply shortages, currency volatility, inflation, and heightened risks of stagflation and recession. Stagflation. That's the word economists are whispering right now. It means prices going up while the economy slows down. It's the worst of both worlds. It means you pay more for everything while your job becomes less secure and your investments shrink. Economists have increased projected inflation rates for this year as a result of the war, with many citing an increased risk of stagflation, the ripple effect, from your wallet to the world. This isn't just an American crisis, it's a global contagion. The European Central Bank has warned that a prolonged conflict will likely trigger a period of stagflation and push major energy-dependent economies, including Germany and Italy, into technical recession by the end of the year. The worsening energy shock from the Iran war has raised risks of a more severe crisis. It may resolve quickly, but the longer it persists, the larger the possible economic damage. Asia and Europe are most vulnerable. The maritime blockade triggered a concurrent grocery supply emergency across Gulf Cooperation Council states. By mid-March, 70% of the region's food imports were disrupted, forcing retailers to airlift staples. And here at home, the U.S.-Iran war has begun cutting into discretionary spending, raising mortgage rates, battering stock markets, and souring consumer sentiment. Mark Matthews, chief economist at the National Retail Federation, said higher gas prices would likely affect consumer spending, particularly lower-income shoppers. U.S. households pay on average $2,500 a year to fill up their tank. If consumers are paying an extra $10 or more per week, their budgets are certainly affected. Matthews said, going out to a movie theater, or going to a theme park, or going out to eat, all those areas would be more likely to see cuts. So it's not just the gas, it's the restaurant you stop going to, the vacation you cancel, the movie night you skip, the small business down the street that loses a customer, the waiter who loses hours. The ripple effect touches every corner of the American economy. What's coming next? So where does this leave us? History suggests that sudden economic shocks, such as wars, pandemics, or energy crises, are often short-lived, with limited long-term consequences for equity markets. The key economic risk in the current Iran war is its duration. Sustained higher oil prices can broaden into other costs and raise the odds of higher rates for longer. Duration, that is the word. Everything depends on how long this war lasts. Experts said energy prices would really depend on the duration of the war. Nada Sanders of Northeastern said, if the conflict does not keep Hormuz materially closed for long, I would expect prices to ease. Long-term will likely see softer than current spikes, unless the conflict fundamentally removes Gulf supply for an extended period. But right now, there's no end in sight. And every week that passes, the damage deepens. Even once the strait reopens, a return to normal prices will be far from immediate. Oil and gas facilities across the Gulf region will need to be ramped back up from minimum operating rates, a process that takes weeks under ideal conditions and potentially far longer for facilities that have sustained damage. For ordinary American families, the impact of the war in Iran will not be a single price spike, but rather a rolling series of shocks that will hit their wallets at every turn. What can you do? So what can you actually do to protect yourself? Here's some practical, straight from the experts advice. First, your investments. For long-term investors, those who don't need to tap their assets for years, if not decades, financial advisors generally recommend staying put to ride out any storm in the market. Certified financial planner Lee Baker said, "If you have an investment strategy, stick to it." Goldman Sachs research recommends an equal split between assets exposed to innovation, those protecting against inflation, and those that benefit from a flight to safety. Second, your home. If you're in the market, personal finance expert Ilona Lamonta-Volkova warns that trying to time the perfect mortgage rate is a losing game because the variables that move rates, quite like geopolitics, Federal Reserve policy, inflation, and global capital flows, are genuinely unpredictable. Third, your daily budget. Tighten up. Review your spending. Gas isn't coming back to $3 anytime soon. Groceries are going up. Prepare now. And fourth, stay informed, not panicked. Informed. There's a difference. Panic makes you sell low and buy high. Information helps you make smart decisions in volatile times. The bottom line. America, here is the uncomfortable truth that no one in Washington wants to tell you plainly. The war in Iran will cost Americans more at the pump, as well as on their utility and grocery bills, while continuing to also cost U.S. military service members and civilians their lives. As long as this war continues, and perhaps for some time thereafter, American households will pay higher prices at the pump, on their utility bills, and on their grocery bills. In the United States, despite record levels of domestic fuel production, prices are more exposed than ever to global fuel interruptions after a decade of building infrastructure meant to link domestic supply to overseas markets. We were told this war would be swift. We were told prices were a small price to pay. We were told everything would go back to normal. But here's what the data actually shows. Gas prices up over 30%. Oil at the highest level since the Russia-Ukraine war. Mortgage rates climbing for weeks straight. The Nasdaq in correction. Grocery prices poised to surge, the Fed frozen. And economists whispering the word stagflation for the first time in decades. Historically, the sitting president's party tends to lose seats in the House of Representatives in midterm elections. And the current environment raises the risk that higher gasoline prices become a central voter concern. This is no longer a foreign policy story. This is a kitchen table story. This is a story about whether you can afford to fill your tank, feed your family, keep your home, and protect your retirement. As Professor Ramamurthy of Northeastern University said, in the long run, this is likely to slow growth everywhere, including the U.S., and add to inflationary pressures. The war in Iran isn't just happening over there. It's happening right here. In your gas station, in your grocery store, in your mortgage statement, and in your retirement account. And you deserve to know exactly how much it's costing you. Stay sharp, stay informed, and demand answers from every leader in every party about how we get out of this and who's going to pay for the damage that's already been done. Thank you for watching. I'll see you next time.